In part 1 of this series, we looked at how Vagul set up India's first venture capital fund in 1986. We introduced the pioneering fund managers of that era, highlighted the hurdles they encountered when the industry was very nascent, met some of the entrepreneurs who shared their experiences of fundraising in those times, and ended with the impending entry of private equity. In part 2, we will look at the entry of private equity and its growth during the tumultuous 1990s. By 1994, some of ICICI Ventures' initial bets began to deliver. The IPO markets were buoyant and the exits were well-timed. Praj Industries emerged as a shining star in its portfolio, as Kiran Nadkarni fondly recalls with pride.
Initially, I think my total financing was about 30 or 40 lakhs. Over a period, I think my funding to Praj increased over 2 crores. When I left TDICI, it was one of my most successful, investments. On my equity stake in the company, I was getting about a 50x return over a period of 7 or 8 years that I had stayed invested in the company. It was the most successful investment from my first fund. The other two investments from the first fund were VXL Instruments and Mastic. And to a smaller extent, the fourth investment that did very well was Kale Consultants.
I think I had the opportunity of at least taking 3 companies public in TDICI. And I still remember how these companies went. Obviously, those companies, I don't know whether they still exist or I don't know the current numbers, but VX Instruments was the first company which I took public. SQL Star, Wintech RF Products, Transmatic Systems, Axel.
By now, Nitin Deshmukh's early bets on pharma turned winners, and Nitin and his team went on to make a string of successful investments in pharma. In the process, ICICI Ventures became the go-to fund for pharma entrepreneurs of that era, as Nitin explains.
Pharma, of course, was predominantly, given my background in pharmaceuticals. I was sort of leading that effort in terms of sourcing deals in the pharmaceutical space. The first deal happened to be Sun Pharmaceuticals at that point of time. In 1991, we invested in Sun Pharmaceuticals. And then after that, we invested in almost close to 40-odd transactions in the pharmaceutical space the entire span that I was associated. We sort of dominated that sector at ICICI, at TDICI, and subsequently known as ICICI Venture. We invested in Sun Pharmaceuticals, Morpen, Newland, Ajanta Pharma, Intas Pharmaceuticals. We invested in the advanced enzymes.
These investments helped us, when I left, I recall that, on a 30 crore fund, I think the fund was returning 108 crores to the investors in the fund, giving a 29% cash-on-cash IRR.
CRISIL was set up as India's first credit rating company in 1987 by ICICI. Vagul was its first chairman, and he handpicked Pradip Shah, who was then part of Deepak Parekh's core team at HDFC to lead this venture. The Harvard-educated Pradip Shah was then a rising star in corporate India, well poised to lead CRISIL in the next decade, when fate willed otherwise. A serious medical ailment forced him to change plans and eventually led him to set up India's first private equity fund.
I was diagnosed with a cancer. And so I realized that I was the lowest paid Harvard MBA in the world when I was in CRISIL. I was getting 7,500 rupees salary, no savings in the bank because I paid off my Harvard debts just before that. So I needed to assure financial security for my wife and son. My wife was 34 and my son was 2.5 years old. And so how did I get financial security? And so I opted for this private equity business, which at that time was very new to India.
Even Pradip Shah, that day, one day he shocked me. He's saying that he's leaving me for George Soros. And I was completely taken aback because he says his compensation was at that time 1 crore or something like that. My compensation at the time was 7,500 per month.
And luckily for me, Jerry Manuelovici, a partner of Soros, had been approaching me and talking to me. He said, let's do something together and so on. And then I said, okay, suppose we do something together. So he took me to George Soros. George Soros said, how much are we putting in? And at that time, I thought of taking only $40 million. He said, well, to $20 million. He said, why can't we increase it to $40 million? Why can't we go larger? So that is how we got going. And fortunately for me, I had a friend from my Harvard days who was big boss of Chase Capital Partners, Jeff Walker. And Jeff contacted me suddenly out of the blue and said, look, why don't we do private equity together? So I said, look, I'm already committed now. So he says, we can work with Soros. We have worked with them in Portugal. We'll work with them here. And so that's how Soros and Chase came on board as the anchor investors. And then we raised some money from some Pittsburgh family, from some Oman investment institution and so on. And we got going with a fund at that time was about 100 crores, which was the first true foreign India dedicated private equity fund.
Soon, Sanjay Kulkarni, who had set up India's first private sector venture fund in 1991, was ready to launch a private equity fund.
In probably what was one of the earliest PE funds, we called it Centurion Direct Fund, in line with our 20th century finance. Now, this was a fund which had again some very, very marquee investors like Asian Development Bank, ICICI, and GIC was an investor in this fund for the first time in India. The fund was $35 million and we made a total of about 10 investments in various companies in India.
In 1995, HSBC Bank set up the first foreign bank-sponsored PE fund in India. P.R. Srinivasan, who we met in part 1, joined them from ICICI Ventures, and he recalls that phase.
In 95, I joined HSBC. HSBC actually imported 2 senior executives from London, and I was the third person who joined the team. The 3 of us were setting up HSBC Private Equity. We were the second foreign-sponsored venture capital fund, private equity fund in 96. $60 million we raised right after Indosian Pradeep Shah.
By now, the Indian market was not only attracting foreign private equity funds, but foreign venture funds as well. Bill Draper teamed up with Kiran Nadkarni, then the MD of ICICI Venture, to set up Draper International, India's first foreign venture capital firm. Bill Draper was a second-generation venture capitalist and part of the famous Draper family in Silicon Valley that had set up many venture funds.
So the Draper International Fund finally was started sometime in mid-95. And I think we had 2 partners based in San Francisco, Bill and Robin. And I joined them, and later Mr. Abhay Hawaldar joined us in Bombay. So there were 2 partners in San Francisco and 2 partners in India.
By the mid-1990s, talent poaching took off for the first time in this fledgling industry. The compensation for fund managers hit new highs, and for the first time, VC and PE fund managers had negotiating leverage with employers, and profit-sharing structures were offered.
But at the same time, the aura of something developing, that was the intended business expansionary phase of the venture capital, where new funds came in, mostly foreign funds. At that time, I never thought in terms of a carry structure or anything like that. These are all not even in my radar screen at that time that this is ever feasible. In fact, I remember asking this, Shede introduced me to this new investor. When you were asking me, what is your investment in the TDICI? I said, I have no investment. So their face fell. So you mean you have no stake at all? These are all instances which I am getting where I could see the ground shifting under my feet.
By end 1995, the IPO markets took a severe beating. A host of issues plagued the markets, ranging from IPO-related scandals, serious governance lapses, and stressed NBFCs. However, a decent assortment of VC and PE funds were now active, and for the first time, Indian entrepreneurs began to choose venture capital and private equity over IPOs. The optimism and highs of 1994 subsided by mid-1996. The general elections threw up a fractured mandate, a coalition government, and a surprise prime minister. For the next 2 years, economy and business took a back seat, and politics occupied center stage. The controversy and negative press on the Enron Dabhol project were another damper for foreign investments. In part 1 of the film, we had seen how World Bank had backed some of the earliest VC funds, including APIDC Venture Fund. World Bank was now concerned about the slow progress made by this fund. That is when Melvin Goldman stepped in and encouraged an alternative solution that eventually led to the first privatization event in Indian venture capital. Let us hear this fascinating story from Melvin.
In fact, my bosses were telling me, let's cancel the money because this isn't going to work. And I said, I procrastinated. I used the bureaucratic technique of not answering because I said, it's not all black and white. It doesn't pay to cancel it. I mean, things can change. And sure enough, the right people came in, including that person whose name I can't remember, and who felt, let's try to bring in new management by, in effect, privatizing.
Sharat Naru was then an NRI based in the US. After successful stints in Procter & Gamble and VST Industries, Sharat was now keen to set up an Indian venture capital fund and met Melvin Goldman to seek World Bank backing for his new venture fund. Melvin bowled a googly at him, as Sharat recalls.
I got to know about the opportunity to go and bid for APIDC Venture Capital Fund, again, very accidentally through Mel. I had gone to the World Bank to meet with Mel, and he had given me an appointment in Washington, D.C. With the idea that I can get him to put money into our startup fund. However, he said, listen guys, we don't back private sector funds, we only back government funds, and there's an opportunity for you to maybe be one of the candidates to be selected to manage APIDC Venture Capital Fund, which is coming up for privatization.
But it was very clear. I mean, I looked through it, and it was these young guys, some of whom were in the United States, most of whom were NRIs, you might say, who want to come back and manage it. But their proposal was clearly well thought out and excellent. And they were selected against really powerful and important groups, which was very impressive. And that's the kind of thing that is exciting about the whole effort.
Now, the rest of it is history. It went through a long process with the AP government, the IDBI Bank, which was the trustee and the settler. There was a committee that was formed to privatize and select the candidate for privatization. ICICI Bank was part of this whole process as well. And in that process, we were selected out of 40 candidates. They were shortlisted to 5, which included Venture East. And there was people like CRISIL, which is a subsidiary of ICICI. There was also Cipla Pharmaceutical subsidiary, a finance company, Videocon, and also one other, Mahindra's in fact, was the final one.
In 1997, coalition politics continued to make a dent on political and economic stability. Making matters worse was the Asian financial crisis, which adversely impacted market sentiments in India and the fundraising plans of Indian VC and PE funds.
Very difficult fundraising market in those days because of that whole controversy surrounding Enron's investment in Chabol.
And then we were going for a second fund round in 1997-98, when we realized that the crisis in Southeast Asia was withdrawing some people, and then
In those turbulent times emerged a new fund, Bearing Private Equity, set up by Rahul Basin, an ex-Citibanker. For the first time, an Indian PE fund was willing to do a control deal, a term that was alien to many till then. Rahul explains the rationale behind that call.
I ran a 800-member IT team which reported into our group at that point in time. So I had a lot of confidence that I could manage business myself, even if we needed to. And I think that whenever we felt that there was a governance issue, we felt that we should take controlling positions. The mindset of doing a control deal in India was not stemming from the use of leverage, which has typically been the reasoning behind control transactions in the West. It was all about getting the governance architecture right and about accelerating growth of the underlying business.
Joining him was Subramanyam from First India Mutual Fund. Subbu, our next guest, points out how they identified IT services as the big opportunity as early as 1997. Together, they went on to script a new chapter in Indian private equity.
April 1997 to almost about July-August 1998, the team spent time coming together, finding their feet, and trying to crystallize on an investment strategy, which was to invest around IT sector.
One of the interesting deals during this period that made headlines was the Indigo Nation, a lifestyle fashion brand. Kiran Nadkarni recalls how he created this deal.
And I remember one of my friends, Pradeep Kar, and I used to, we used to sit in the evening over a beer and discuss how do we fund, where do we find entrepreneurs? And one of the things he suggested was like what Bill did in Silicon Valley in the 60s and 70s. He said, let's go out and, pull out some successful executives from large companies. And I think we did that very successfully in two companies during the 95-99 timeframe. The most well-known, the prominent case was of Industry Clothing. What we did was essentially pulled out the entire top management of Madura Garments. The CEO, the marketing director, the supply chain director, the brand managers, the entire team of some 6 or 8 people left one fine day from Madura Garments and started Industry Clothing. And that, I think, I recall that, I think the day when we announced the investment, the next day there was an editorial in Times of India central page by Debashish Basu about, the kind of deals that should be funded. And they mentioned Industry as a case that should get funded by venture capitalists.
Around this time, the Rajan Raheja Group's investment arm, headed by another ex-Citibanker, Shankar Narayanan, had created buzz in the markets by acquiring controlling stake in Johnson Tiles and Exide. These deals were, however, not housed in a formal private equity structure, as Shankar explains.
While Hathway was strictly not a pooled private equity fund, it was a single family's capital that was deployed for very long-term investing. We had some of the most outstanding professionals in our group, from IIM Ahmedabad, the chartered accountants, IIT background, etc. And when I joined Hathway, the first deal that came our way was a company called Johnson Tiles, which was India's largest ceramic tile company. And we intervened and we pretty much bought the business without doing any due diligence, and we consummated the deal very fast. There wasn't management, so I, along with a couple of my colleagues in Hathway, Vijay Agrawal and others, we ran Johnson Tiles. It proved to be an enormously profitable investment. I'm particularly proud of because we did good transactions, though we didn't probably have the rigor modern private equity brings in terms of diligence, etc. Because I think we got the general trends right.
Fund managers those days did not have the expert advice of Big Four accounting firms nor top lawyers. That, however, did not prevent them from experimenting with cute transaction structures that deftly bypassed the prevailing regulations. Let us hear some of those innovations.
UTI came into this picture not as a co-sponsor. Subramanyam was a good friend. And I cannot explain to you the exact reason why UTI gave me a tax shelter. At that time, there was nothing which governs venture capital country. But UTI was tax exempt, I was not tax exempt. The new company was not tax exempt. So I roped in UTI and gave them 50% tax efficient. And so that's how the UTI came into the picture.
CCI, prevented me from investing in equity. We had to come with some unique financing instruments. One of them was conditional loans, where the loan was provided without any interest. The servicing of the loan and repayment of the loan was based on a royalty on the sales of a company if it became successful. It was a good instrument as long as the company didn't become very successful. When it became successful, then it meant a significant outflow from the profits of the company, which the entrepreneurs didn't like.
Now, interestingly, US investors at that time didn't know much about Mauritius, and neither did we in India. So this fund was actually incorporated in the Cayman Islands, and the Cayman Island fund had a subsidiary in Mauritius, and then from Mauritius investments were made in India. The reason is, of course, that we wanted to take advantage of the Indo-Mauritius treaty and therefore get the various tax benefits which were applicable as per the treaty.
In the 1998 midterm elections, the Bharatiya Janata Party emerged as the single largest party and formed a coalition government under the dynamic leadership of Atal Bihari Vajpayee. There was all-round optimism and markets were well poised to recover. The Pokhran atomic test sent a strong signal to the world on India's capability and intent and made the nation proud. However, as expected, a host of countries were quick to implement economic and other sanctions, which became speed breakers for the revival of the Indian economy and VC and PE activity. By now, the Indian IT services industry was in takeoff mode. Companies like Infosys, Wipro, TCS, and even smaller ones like Putney Computers and Mastech were riding the wave, and the Y2K opportunity was looming large. One of the smaller companies was BFL Software, later renamed as Mphasis. Promoted by the Keshav Bangur family and led by a professional management team, they went public in 1993. Soon the promoters faced some financial difficulties and decided to sell their stake. Several IT companies were in the fray, but eventually the surprise winner was Baring Private Equity. Let us now hear from Rahul and Subbu how the first control deal in India unfolded.
We chose to do a control transaction only because we were clear we could not partner with the owners, yet we liked and wished to align with the management. Convincing promoters to shed their stake and have a loss of face in the social status was the next big hurdle that we faced.
It was extremely interesting as to actually executing upon a control deal because the control deal that we did was the very first one that invoked the new takeover code. No one knew anything about the takeover code or what it implied. We spoke to almost all the bankers at that point in time.
The investment committee had real jambawans of our time. They were global guys who had got exposure in UK and Europe across private equity opportunities of all shapes and kinds. They had done private equity for almost half their lifetime, and here the Indian team had never done a private equity deal before. The typical questions that came up for us to cross were, as a private equity fund, can we make investment in a listed company? Second, is this the best first deal of taking control? Other promoters who are to align with us in businesses going forward might shun us because we are taking control of businesses and maybe relieving the promoters of their shareholding.
The Emphasis Control Deal will go down as a seminal event in the annals of Indian VC-PE history. It gave immense confidence to the marquee PE funds that entered India in the next decade that it was possible to do a control deal in India. Add and create value as a PE investor. It also sent a signal to entrepreneurs that they cannot take control for granted. There were very few women in the Indian VC-PE industry in the late 80s and 90s. Only one of them managed to play a long innings. Jayanti Hari, who started her career with ICICI Ventures.
I don't recall any discrimination. It was very open. I felt very free to step up, to express dissonance, about an investment proposal. I don't think I even thought I was the first woman at that point in time. TDICI was a chip off the old block in terms of culture, very much like ICICI, thanks to Baghul actually, because ICICI had a very healthy women ratio.
The number of women he hired. Brilliant. And he never made any noise about gender diversity, nothing.
In part 1, we had seen how VC funds had preferred Bengaluru as their headquarters. The entry of private equity in the mid-1990s brought a change. New Delhi emerged as the location of choice for many funds, and Subbu explains why.
As a private equity fund, we consciously chose to be headquartered in Delhi because the regulations, foreign direct investment regulations that were applicable to private equity were not very well defined. And the purpose of being in Delhi is to go and seek clarification with the ministry and the bureaucracy as to whether the investment in the particular opportunity would be permitted or not.
ICICI Venture was the most successful fund in the 1990s. Let us try and understand what was special about its team, leadership, and culture that set it apart from its peers of that era.
When we started expanding the team in TDICI, we decided to go to IIMs to hire young talent out of the IIMs instead of going to the public financial institutions like ICICI, IDBI, or IFCI. One, as I mentioned earlier, that it was, this was not a lending business; it was an investment business.
Most of these professionals, actually, I should say, came from very humble backgrounds, humble family backgrounds. Most of them had pretty much, I should say, background in terms of parents being in the government service, etc. I think predominantly in government service at that point of time. And I think, having said that, each of them had very great hunger and did very determined in terms of and the commitment that we saw in each of these professionals and who to excel in some way. Today, I think I'm proud to say that most of these professionals have done exceptionally well, being the heading many of the funds across the country at various points of time.
We were blessed with that sort of combined experience of having a process-oriented system like ICICI, coupled with what we could learn either through our training in the World Bank or through the World Bank or through or the learnings we have gone through certain learnings as we move forward, and we're able to combine it together. So I think that gave us a lot of confidence to the team.
I think it was a very unique culture in some senses. Most of us were not by nature very aggressive people. Most of us were very long-term oriented. Yes, we had our differences, but the basic value systems in terms of making an investment today takes 3, 5, 10 years for it to show fruit. And there was none of that sales-oriented mentality.
It's not very different from the ICICI. If you go to Bombay, you will find that ICICI bank people's everywhere in the banking. It's the same culture gets repeated in TDICI. There's a lot of freedom of action, freedom of thinking, and they could come up with ideas, and that ideas can be accepted or sometimes rejected, but nothing stopped them from innovation. And the management was entirely professional, since I did not interfere with that. Kiran was in charge, Deshmukh was there, and quite a few people were there at the time. They really were responsible for that. They knew that it's their sense of ownership that of ideas and the execution.
It's a talent vision of Mr. Bagul, not just the ability to believe in it, but to spot them in IIMs, to convince them to join, and to give them the environment to grow.
Some of the fund managers of that era are still going strong today, having survived 3 decades and more in a highly dynamic and competitive industry.
But today, founders are even at a young age, are willing to build companies and help them, one of them grow, and look at options of exit in various forms, either through an IPO or through a financial sponsor or even a strategic sale. And the conscious fact is, yes, they understand that VCs or private equity guys are partners in the firm, and they have to provide an exit to them.
What has changed significantly between the 90s and now, I think, is the depth of entrepreneurship that we have today. Today, entrepreneurship is not limited to the large business families. The entrepreneurship is right out of everybody's garage. So I think is one big difference. Second is that India today is a $3.5 trillion economy compared to the 260 billion it was in 92 when I started.
How has the Indian venture capital industry and the associated entrepreneurial ecosystem evolved in India in the last 30 years? I would say I probably could not have asked for more. The promise of India is coming true.
We began part 1 with Vagul, and it is befitting that we end part 2 with the legend himself. There was a Vagul hand behind many events and episodes that unfolded in Indian venture capital and private equity during that era.
But Mr. Vagul basically took an enormous leap of faith, and I would call it leap of faith, with his charisma and vision and his naturally human-friendly style. I mean, naturally, I would say he's naturally friendly as a person, right? At the same time, retains complete objectivity. It's a beautiful combination. He took a leap of faith on the talent of India. He had a very unique style in those days. He didn't have an office. He sat in a small lounge, and you would meet him in his lounge. In Mafatla Chambers, if I remember correctly, in South Bombay, right? So I think it was, you can argue that others could have filled that role, but we were so fortunate that somebody of his vision, and that vision that he had, and which he saw, and I love the fact that in a very Chennai style, he never beat his chest. He never had any hubrism. He knew what he wanted and he gently guided people to go in that direction. And I was one of those beneficiaries.
Yeah, 90s, the economic reform package. I think it was time many of us welcomed the package, and so some of us felt that it didn't go far enough, and that feeling would continue to persist. Even now I feel that we have not gone far enough. But at that time, it was a breath of fresh air, namely that whole thing. And many of us were excited that this will mark a new chapter for in India's economy. At the time, I knew that CRISIL also would come up and TDIC.
If Georges Dourayat is considered as the founder of modern venture capital, Vagul is truly the founder of Indian venture capital. We hope that the first 2 episodes of our docufilm have provided you with a good perspective on the rich history and heritage of Indian venture capital dating back to the mid-1980s. In part 3 of our series, we will cover the dot-com boom, the debris and devastation it left behind, and how a new set of dynamic fund managers took Indian private equity to dizzying heights in the ensuing decade. This docufilm is dedicated to all those funds, fund managers and their respective teams, entrepreneurs, intermediaries and others in the ecosystem who laid the foundation for this great industry that we are so proud of today.